Hey everyone, we're
Yeah.
alive. I put on Twitter. I wrote you have to put like a message to go with the stream, and I wrote Strat Chat live.
Strat Chat. Is that what we're calling it now?
I kind of like Strat Chat as the name of the show.
All right.
It's kind of cool. Strat Chat.
Strat Chat. Yeah. Not
Yeah.
Chat. Strat Chat.
Strat is that's like what we want you to do.
Yeah.
Strat, but we
That's what you do. That's the verb, and then the noun is Strat Chat.
Yeah, exactly. I feel like we're just gonna end up talking more and more about strategies, because before all we had was like incremental improvements on the app to talk about, and now we're getting into the meaty bit, which is actually deploying stuff and putting real money in it and seeing how strategies perform, and that's all anyone actually cares about.
Yeah, well, we also are having a bit of a what would you call it, like a producer-consumer split to some degree in the way that everything's set up with the web app too. So
True.
we have a new web app, which is very, very softly launching, and we'll do more of a proper launch in not very long. But the website's up, and basically it's open source, so anyone can propose something, but people don't have to. I'm putting up strategies that I've been writing and using, or we've been writing and using, and basically those are available in sort of like a wizard type form where you just click through and you set the parameters that can be reconfigured for a particular strategy, and then you can just deploy it without actually needing to download the app.
Should we just show
set
that?
up the app? Yeah, why don't you just set it up? So it obviously is just more streamlined. It's not as easy as just going to Uniswap and clicking swap, but it is much easier than making sure you have a Mac, downloading the app, getting the settings, learning Rainlaying, understanding the interface, deploying the strategy, writing the strategy. So it's like 10 times easier, 100 times easier, something like that. Here you go. There's a video.
But also we can make it easier and easier. I think the point is that I think you can make it easier as well. So we can listen to feedback. We can make these strategies easier.
I've already put up like 10 issues to make it easier. Yeah, like I've been using this too. I've been, even though I've been using the app to write the strategies, I want the same experience that everybody else has with deploying these. So I will be in the trenches dogfooding, right?
These strategies are pretty easy. I mean, if you just want to do a DCA, which, you know,
I'm not saying it's difficult. I'm just saying Uniswap is just one button. So there's more than one button. There's like 2 or 3 buttons. It's not significantly more difficult. It's pretty easy.
If you want to buy WETH, you have to say how much you want. You just have to set a budget. So if you want to buy $5 of WETH every day for 20 days, how many buttons was that? That was
3.
Oh, 1 to choose the strategy.
Yeah, 1 to choose the strategy.
2, 3, and then 4.
Okay. So it's 4 times harder than Uniswap.
yeah, but if you want to still use Uniswap, you still have to put in how much you want to swap.
Yeah, I know. I'm kind of just trolling. It's just on Rails though.
Also, the point is that on Uniswap you can change setting. Like you can go and fiddle with the slippage and stuff. So you can get into more fine-grained control, or you can just go with the default. And I think that's where this could go as well. There could be like same defaults for this stuff.
The actual filling out of the form is very easy. You've done a good job of that. What's really cool is that all of these forms are built using like a standardized config that goes with the strat. So you don't have to know how to build web app to actually contribute. You just have to say, it's literally like in the same part where the settings are for the bindings and everything else in the strategy is just more settings. Like these presets are part of the settings. So where it said like $5 and $10, that was just a configuration. And then the description is just a configuration. So the form is like a form builder type thing on the back end. which means adding strategies to this interface is really just a matter of configuring it. So that's really cool for iterating, I guess, like experimentation. So if there's a strategy that we talk about in the main channel or something, and we go back and forward and we're like, that's a cool idea, and then we update it, and then we put that in here. The process of actually getting something from the production side in the app into the consumer side in the web app is really just some configuration and some testing, and then it's good to go. So hopefully that should mean, like, there's relatively few strategies in here right now on our soft launch, but hopefully it doesn't really take long before we have like dozens of strategies up in here, and there's things. I think probably the most difficult thing is just going to be learning what all the strategies are. Like at the moment, there's only 2, so there's not much to learn. But at some point, it'll be like there's enough strategies that you could actually spend like a weekend like clicking around and like learning different things. Like if
well, people will try stuff as well. I mean, and the point of what you're saying is about how to set up the GUI, like how to create an interface for the strat, is that eventually anybody could do it. So you're the one doing it right now, or like we're writing strategies and making them, but the vision is that this could be fully permissionless. So anybody could write a strategy and then create an interface for it. And then that could go into like a marketplace of strategies. And then, you can see the performance for the different strategies that people have created.
Yeah, I'm going to make an on-chain registry for this at some point, but it's not worth waiting for the full on-chain registry to just get started on having a website that lets you deploy strategies easier. So it's just in open source GitHub. If you're a developer, you know what that means. If you don't, it's just a place where code goes in like a collaborative way. So it's,
it's just there. Can at any time. You can. It's github.com/rainlanguage, and you can actually see all of our code all the time. So you can see the on-chain code as well as the app codes in here as well, and now the web app code as well. So like literally, we don't have a line of closed source code.
Yeah,
true. I don't think we make enough of a point about that. Actually, we should just always remind people that if you ever concern,
can I give the disclaimer? It's all open source and it's not financial advice, and everything that you put up is on chain and will be used against you on a blockchain.
We're definitely not giving financial advice. Never repeat that too many times. But if you did want to understand the strategy, you can watch a video. So on our YouTube, which is, what's our YouTube channel called? Rainlang?
I think it's just Rainlang, yeah. It's for the whole language.
Nope, it's not Rainlanguage. Wait, what is it? Your channel. Oh, Rainlang XYZ. Here it is. So we're youtube.com/RainlangXYZ.
Yeah, there you go. It's got all the live streams and it's got 3 videos. I'll be making more videos. So I'm thinking for the short term, the strategies that we should have up here, there's this dynamic spread one, which I don't think we've talked about on a live stream today. So today, like ever. So I'm going to talk about it today. There's auction-based cost averaging, which has an explainer there, and that one's actually already up on the website. And then I think we should do simple stuff like just regular limit orders. We should be able to do a limit order, why not? But also like a one-time auction seems like something that would be pretty useful. Stable coin trading. So if you have a basket of stables that all supposed to have the same price, but they fluctuate day to day just due to the market, you should be able to trade against the differences in the stable pairs. So there's a few strategies there that I think we should just get up straight away. That would already make 5 strategies, and then multiply that by a bunch of different networks and a bunch of different tokens, and that's probably a pretty good start. And then we can talk about adding, like I thought it'd be cool to do that one with the dollar cost averaging, but then when there's a pump, you like try to sell the pump if it's above your cost average. So you just like jump on it. That's like a few of those like hybrid strategies. It's like, it's a dollar cost average limit, a dollar cost average strategy with a automatic limit order that's sort of like attached to your average. Like a few things like that could be fun to add. So I feel like we could get a dozen strategies up here pretty easily in not that long. The slowest thing is actually just me testing everything and like checking that it generally works, and just going through that process with doing it with my own money, so it takes a little while.
I mean, on that note, should we talk about this strategy, the dynamic spread strategy, and what you've learned by trading it with your own money? I'll stop sharing.
Yeah.
Do you want to share the app, and then you can show the charts and stuff?
Yeah. Okay. Sure.
By the way, if anybody has questions and you're watching, you can either drop them in our Telegram, or you can just reply to this tweet on X, and I think I should be able to see, yeah, and we'll respond to you. It says that there's 23 people watching. I don't know if that's real or not.
That's cool. So I can share the strategy. I did think you didn't want me to show specifics of. I'll show mine.
I mean, it's your
yeah. So we've actually deployed this 3 times with like a few different tokens and networks and network market conditions, which is cool for talking about now because we actually have like some data on a few different ways that it can go down. But the one with just my money in it is unfortunately kind of the least interesting one. Actually, no, it's not, because it
had a pretty good run. It just got boring at the end.
It also, I learned something, which is always good, right? So here's the app. You getting that?
There we go.
Yeah, so maybe the first thing you'll notice is that it ran out of ETH. So even if you don't know what the strategy is,
doesn't mean you lost all your money. It doesn't mean that you lost all your ETH. It means you sold it all.
No, there's $5,000 here. I didn't lose all my money. It's just this strategy is fundamentally a strategy that is supposed to be two-sided. So you pick 2 tokens. In this case, it's USDC and ETH. And then it's supposed to have a budget for both of them at all times. And it's kind of like 2 cost averaging strategies running at the same time. As the market moves, if the market's going up in one direction, so let's just say like we're doing prices in ETH for this explanation. Say ETH is getting more expensive, it'll be selling ETH. And then if ETH gets less expensive, then it will start buying the ETH back when the market goes below what it sold the ETH for. All right, so it's trying to make a profit. So it knows the average sales price. So as soon as the market drops below its average sale price, then if it buys back the ETH, that's profitable. Like it's just going to end up with more ETH if it takes all the dollars that it made from selling and just puts them back into ETH. So conceptually, that's pretty easy. It works the same as the auction-based cost averaging, where you have a curve which is auctioning off the tokens, but it's doing it in both directions. So you've got one like this and then one like this. So they kind of come in together. So it's basically the market's doing this, and then it's coming in from both sides. And then at some point, it's going to get the spread between buying and selling is going to get so tight that even a very small market movement is going to cause a trade to happen. So when the market is moving a lot, it will hit one of these spread curves more quickly because they're further apart and the market does a big move. So it'll put in a bigger trade. And if it takes a really long time, the spread's getting tighter and tighter and tighter over time, the market is moving less. So it'll do a smaller trade because it's saying, okay, well, this trade is closer to where the market was at like last time. So it's less exciting, basically. It's a smaller move, it's less exciting. So it'll put a trade in, but it'll be a smaller trade. And the reason it wants to do that is it doesn't really want to overcommit to a particular price. It wants to be relatively fluid in the way that it works, because what we're trying to do is profit off the market moving in a range like this. But if the market does a jump and then is just somewhere else, we don't want to be overcommitted to where it was yesterday. We want to also be able to continue functioning at the new location. And that's exactly what I didn't do with this. So it was going fine, actually. Let's have a look. We have a volume tab now on the app, which is cool. So I did almost 5,000 total volume. Okay, I did 6,000 volume in dollars, and I did 2.6 ETH of volume. So there was some volume, there was some trades. It all kind of went through. There's all my trades. It actually did loads of trades. Like this isn't even all of them. So it was working great for a while. I think it was making like almost like 100% APY. It was actually doing really well. And what happened is the market in ETH did a fairly big jump upwards. And because I ran out of ETH in the vault, it stopped trading. And because it stopped trading, it couldn't move the average any further. So the strategy is basically just paused, waiting for me to either put more ETH in which case it'll start trading again and moving that average further up, closer to where the market is now. Or if we get a dump down to, I think, 2,530.
Yeah, it's here. It says 2526, it says.
Yeah, 2526. But this is on Base Network, and Base Network is consistently about $5 to $10 below the price that you see on TradingView. So in my head, it's 2,530 because that's what I see on TradingView. But you're right, it's 2,526 on Base.
Right.
So as soon as it comes back down here, it'll kick off again and start rotating out. So either I need to top it up or I need a bit of a dump so that it can start clearing itself out again. This is sort of the learning that I want to try to implement, which is I want to make a version of this strategy that has a on-trend and off-trend throttle. So basically what happened is because the market moved really fast, it forced a lot of trades to go through in a very short period of time, which is fine from the perspective of moving the average, but was really bad from the perspective of me running out of money on the ETH side, because it put through quite a lot of trades really quickly due to just the volatility in the market. So I want to make a global budget. So it'll say, sure, put the trade through at the large rate at the price change, but over the course of, say, a day, I'm going to limit the amount of trades to, I don't know, $500. So if I've got $5,000 in this strat, that would mean that I'm guaranteed to have 10 days of leeway for that average to reestablish itself at the new position where the market's at. So instead of just blowing through its whole budget in like the first few hours of the market moving, and then it's sort of needing to keep going, you can force it to spread itself out over like a few days. And actually, I don't exactly know, but just eyeballing the market, I'm pretty sure that if I had kept the vaults topped up, there were actually a few reasonable dips along the way to where the market is now that would have actually caused it to start at least partially resetting itself. So I feel like it wasn't it wasn't totally wrong. It's just I either needed to have way more money or I needed to have a throttle. So
or you could have just reduced the size of each trade, right? As well, you could have just traded less when you were trading.
that's true. Yeah, I mean, I had the trade size set at $100. So I mean, if you just look at the history, you can see that if I'm dumping like
Yeah.
some of these are like literally almost $100. If I'm really dumping like $100 onto the market, like repeatedly over and over again at like every hour or two, look, 920, 620, 634, 7 for like less than an hour. Yeah, like I'm going to blow through my 5,000. And that's not even 5,000 because I actually had it half and half. So it was like 2,500 on one side, 2,500 on the other side. So yeah, I blew through that budget pretty quickly, actually. So you're right. I could have just made the trade smaller.
Yeah.
That's the other way that I could have addressed this. So I feel like this is a good experiment for like a 2.0 version of this strat that is exactly the same as this, but just with like a global per day or per hour rate limiter to just allow it to just sort of ride those really big spikes out a bit better.
Because the goal is to have the strat run as long as possible without you want to basically, you're trying to optimize it to trade back and forth as often as possible and run as long as possible because it has a spread. And so the more it can trade over the long term, you're just starting to start compounding that spread, even if it's only tiny amounts each time you rotate back and forth. If it just keeps doing it over and over and over, and you can run on and on and on for a couple of months, then you could actually start seeing real results once it starts compounding.
Yeah, the volatility was great. I think it made like 3% in 5 days or a week or something because the early volatility was great. It was doing pretty big price movements and it was generally taking advantage of that. It's just that eventually the price moved and then didn't come back. And basically the strat treated that like a pump, expected it to come back down again, and then it didn't come back down again. So it needs to have a defense against that situation, basically. So that's what I'm going to try to add.
I think the other thing that's interesting about this strat is that one thing that clicked for me is like it doesn't have a opinion about which token is better. So it's not like it's trying to consolidate back into USD. Let's say it doesn't actually know whether you want USD or ETH. It's just saying that whatever it does, it will make sure that it ends up with more of what it had than the last time it traded out. So if you sell a bunch of ETH, it will try to buy back that ETH cheaper than what it sold it, and the reverse. If it sells a bunch of ETH, it will try. So if it buys a bunch of each ETH with USD, no, it'll try to sell the ETH at a higher price.
Yeah. I mean, the next time I deploy this, I think it's going to be cool to do it with Bitcoin and ETH.
Yeah.
So I'm going to add the throttle and then put BTC and ETH into this. And I actually want to sell my Bitcoin into ETH, even though I know the ratio is generally trending down. But because I know that the ratio is generally trending down, I could just cost average from Bitcoin into ETH and just get once-off sales and cost average it. Or I could throw it into this, and as long as it's rotating, be making a profit denominated in ETH and Bitcoin. And then if the ratio keeps trending downwards, eventually it will actually sell all of my Bitcoin into ETH, but probably just way more than if I had just done a straight cost average over that same period, because it's still cost averaging, but it's also taking the opportunity anytime there's like a temporary little pump in that chart to sort of fully or partially reset itself and then start the cost averaging process again, but from a better baseline. So my experiment is that I will update the strategy to have throttle. I'm going to put some Bitcoin and ETH in here. I'm going to let it ride for a while, like a few months or even more. And hopefully that will result in me getting maybe like 10 to 20% more ETH than I would have if I had just done a straight cost average. So that's sort of the way I would like this to go in my head. Obviously, there's a million things that could go wrong, but that's that's life. So that's kind of what I did on my own strategy. Should we talk about the other two deployments?
Yeah, so we also help other people run strategies. If anyone out there needs help with market making their token, get in touch, because we do this work for money. We'll help you do market making and write strats for your token. But we did this for a couple of people. We used the same strategy, and one of them was launching a new token, and we just used this as a liquidity strategy. And so it was running from like basically the first block that their token went live, and it was really good. It was basically a way of, they had like a pump at the beginning, so it was like accumulating treasury for them. And actually they ended up deciding to pause the strategy, but had they let it keep going, it would have then provided buy side liquidity later on once that initial pump kind of cooled off.
Because that was actually a case where it was a pump and then there was a dump, because it was part of the period of the launch got a bit overheated, which is pretty common for launches. So because it wasn't the situation that happened to me that was like a pump and then a pump, it was a pump and then a dump. It actually came back to where it was originally trading at. So that actually, like, as far as the strategy is concerned, that will work perfectly.
Yeah. I mean, what's interesting is that, because you're basically talking about it as a trading, well, from the way I think many people will listen to what you've just been talking about is your own money, and it's more of like an investment or a trading strategy for managing your own portfolio. Whereas in this case, although projects want to be able to trade profitably, which there might be solution there, so make sure the market's healthy, so they want to provide liquidity and act as
cutting out of it there.
Oh, sure. I was just saying that projects want to provide liquidity and make sure the market is healthy for their token. So this is like a age-old thing in traditional finance as well. Market makers exist, and they're there to make sure that they got like buyer and seller of last resort. So if the market's quiet and somebody wants to sell, there should always be someone to buy. And on order books, you literally need someone on the other side of your trade. And so that's what traditional market makers do. We obviously on chain, we have automated market makers already, so there is liquidity there, but increasing the depth by LPing more ends up costing you, because you lose money due to IL, impermanent loss. And the reason you invented Raindex was because you experience getting impermanent loss on providing liquidity for a token on Uniswap in the early days. And so this is a much smarter way of doing it. So like the way I explain it to people is like, you've got your regular pool where the constraint is X times Y equals K. And then you've got your Raindex strategy, which is kind of like its own pool with its own tokens that you're fully in control of, except instead of X times Y equals K, you've got this constraint written in Rainlang, and you can write whatever you want. So it can be smart, and fully customized to where you're at, and you can change it at any time. So you can have your own parameters that we just talked about. You can take into account time, so it can actually, like, it has a knowledge of what's happening over time, which a pool doesn't. I mean, as you've said before, a regular AMM pool the price is only ever a function of its balances. Whereas with this, we can make the price a function of time, of the previous trades that have happened, and it can have an opinion about what the price should be, or more of an opinion, taking into account more of the info and the info that you want. So yeah, so these guys were using the same strategy, but in a market making context, and they're trying to be the buyer and seller of last resort, kind of. And so when there's a pump, it means people are wanting to buy the token, and this strategy will sell them the token. And then where there's a bit of a dump, people want to sell the token, this strategy will buy the token back off them. And from its perspective, it's doing so profitably, but from their perspective, it's providing extra liquidity. So the same amount of trades that happen will move the price less because there's other liquidity in the market, which is like dampening the volatility.
Yeah, if you watch the whole explainer vid that I did on the dynamic spread, I called it. I actually am presenting it as market making rather than trading. You can do it both. It's even configurable so that you can tell it to worry less about profit, like to kind of like a scale. Like you can configure how much trading history it actually wants to keep. So when it's deciding whether it's profitable or not, it's going to be looking at its history of trades, and you can actually sort of cap that. So in my example, if I had gone the extreme route and set it to 0 history, it would still be trading right now. It might not be profitable, but it would rather than say, oh, but I made all these trades last week at this point that I need a profit to cover those. It can have 0 history and say, okay, I'm just going to keep trading it like relative to the last trade that I made. So I make a trade, and then straight away, that's the new price that I'm going to base everything around. Oh, I made another trade, I'm going to base everything off that. And it can just have like goldfish memory. Or you can configure it to have something in between, and you can say, I'm going to track like the last $100 of volume, $1,000 of volume, and I'm just going to cut loose anything that's earlier than that. So from the perspective of market making, it may be that you have several goals, so that there's a bit of tension there. Like one of your goals is sustainability, which we call profit as a trader, but like it's got to be sustainable. You can't just make a loss forever. And then another might be, well, you're also trying to have a liquid token. And there's nothing wrong with having Uniswap pool. I would just say that there's sort of diminishing returns at some point where, like, because of the way slippage is calculated and everything, like the first, I don't know, however many, like a couple, like 20K, 30K, 50K, something that you put into the Uniswap pool is great because it means that people can put in trades for like a few $100 or a few $1,000. And then to get to the point that you can then handle a $2,000 trade or a $10,000 trade or a $20,000 trade. Like you just have to keep piling in more and more capital into that.
Here's a question.
Yeah.
Here's a question, something that's been on my mind. What is the relationship between, like, okay, we all know that there's a relationship between liquidity and slippage. So the more liquidity in a pool, the bigger trades you can make with less slippage, because literally your trade moves the price up the bonding curve less.
Yeah.
Far vertically because it's flattened out, the more liquidity there is. And that's just the maths of the pools. So what is the relationship between that and price discovery?
You have to grind through all the capital that's sort of committed at every point on that bonding curve until you get to the new point, which is actually one of the reasons why I made this strategy with the dynamic spread. Because remember we were doing stuff with tranches before? We were like talking about that on the live stream. We're showing a tranche-based approach where it has sort of like a grid of limit orders either side. It has a similar situation to the AMM pool, where to get from price A to price B, you first have to make a whole bunch of trades along the way. It can be a single trade in your example, but it probably is more likely to be a bunch of trades in reality. You have to like make all of the trades along the way to get to point B, right?
Yeah.
Whereas with an auction-based approach, to get from point A to point B, the auction just gets to point B.
I think that's not my exact question. Although that is also what you're saying. What you're saying is also true and interesting. But I mean more like in a low liquidity, high slippage pool, it means that for some people, they won't make the trade because the price of the last token, like the slippage is too high, and they don't value the token as high as they're going to have to pay to make the size of the trade they want. Right? But then also some people just make the trade because they want the token, and then that moves the price more for the next person. So the next person who comes along, or like just in a series of people, 10 people queue up, they're like, we all want to buy this token because we believe in it. And they actually don't have a firm idea of like what they value the token, but they know they want it. They think it's going to be somewhere above where it is now. So they just want the token. But when those 10 people queue up and buy, the price is going to move more if there was less liquidity in the pool.
Yes. You're just talking about speculation?
I'm talking about price discovery. So what I'm saying is like there's a new price set.
I think every trade is price discovery because we say the price of a token is the last trade that it traded at. Like that's probably not even the best way to give something a price.
No, I mean, well, on Uniswap you type in how much you want to buy, and then it tells you the price. So
right, which is based on wherever the previous trade landed.
Yeah. Exactly. But if there's more slippage, then that previous trade will move the price less.
More. If there's more slippage, it'll move more.
Right. Oh, yeah, so more slippage. If there's more, but there's more, and there's more liquidity, it will move it less.
Yeah.
So what I'm trying to think about is like, how does having more liquidity, does it help with price discovery because more people can trade before the price moves? Because like, if the price goes from, and it's not saying it's a good thing necessarily if the price goes up. I'm saying it could be a bad thing because if the price jumps from 50 to 80 in those 10 people, let's say, it's $50, now it's $80 in that for those 10 people, then the 11th person is like, wow, the price really jumped in the last 10 trades. So I may now feel like, okay, there's been a significant jump. So I'm a bit more hesitant. Whereas if I believe in the token generally, but I haven't seen a massive jump yet, then it's like I'm more like, okay, cool. It hasn't really had that pump yet. I can jump in.
So when you say price discovery,
well, I think of the psychology of price.
How are you defining it in this? Do you mean how confident are we that the number that we're seeing on the screen represents the true intrinsic nature of that?
Not the true intrinsic
token in that moment.
True intrinsic thing that's in everyone's head. So it's obviously circular.
Yeah.
So that's why it's an element of psychology, and that's why I said the person may think that. But like
the average of everyone's brains.
Yeah, because I think that is price discovery, even if there is intrinsic value. I guess most things don't trade at their intrinsic value. They trade somewhere between if there is an intrinsic value, somewhere between that and.
Forget I said intrinsic value. I just mean the number in. How much do we trust the number on the screen? Is that basically what you mean?
Sorry?
Do you just mean like how much do we trust the number on the screen?
I think so, because what I'm thinking is like, this is what I've been thinking about, is that if it's low liquidity, high slippage, and you get some excitement, you'll get this like run up really quickly, which then every run up triggers a dump. So, and then nobody wants to get in on a dump. Well, they should, but they don't.
Well, this is literally the point, like the difficulty. This is, if anyone watching goes out there and try to write a strategy for market making, this is exactly what you'll run into, which is this pump actually a trend, which is what happened to me, and actually having a lot of liquidity in the pool just means that pool is going to take even longer to get to the new true price, and it's going to lag. So therefore we don't trust it because it's actually lagging. Being behind is still inaccurate, right? Versus actually, if there's going to be a pump, it's just a short-term temporary thing, and then it's going to dump again, which is what we saw in the case of this launch, because there's often a period during a launch where the token gets overheated and then like calms down again because everyone's like excited and it's just chaotic and it's like the launch. And therefore having more liquidity makes the spike smaller. Therefore the accuracy is improved because you had more liquidity to prevent the spike in the first place. And the accurate thing is exactly where it was before. So is the accurate price, the price discovery, is it the price that we just saw 10 minutes ago, or is it the price that it's about to be in 10 minutes, which is somewhere else maybe? And that is like, you don't know that when you're running a trading strategy. You don't know whether a pump is a pump and then a dump, or if it's an actually like, oh, actually no, there was some new fiscal policy announced in Japan or America, and actually that means the token's worth this now. Like, how does the strategy know that?
I mean, for a launch of like basically a meme coin, which arguably I'd say 90% of tokens are, if not 99%. Like I've never seen a chart that goes and just plateaus. I've never seen that. I've only ever seen charts that go like this. Like, oh, they go down. And then sometimes when they get down, they end up a little bit higher than they were before they went up. But every chart looks like this.
For things that are straight memes, yeah, because they're memes. That's what a meme is. Like, you could just look at Google search history for any meme and it probably looks like the same chart.
Exactly, yeah. And so
if there's a project that is actually like building something, you still get that like launch spike a lot of the time, and then it does sort of crash, but then it sort of does recover at some point because they actually build something, and then people are like, oh, they built that thing. Like Ethereum itself is still going because they built Ethereum, but that was a pre-sale,
meme coin,
pre-minted launch. They had a launch party and like sold the token for like 30 cents or something. So it basically is the perfect example of like a thing that launched and went crazy and then dumped and then came back again when they actually built something.
That's true. That is true. Okay, so I mean, all to say that I was just wondering, like with the token, when you're applying this strategy to a launch scenario, I'm thinking about why it could be good, like you said, to lessen the spike, because actually you don't really want a massive spike when you launch a token. So in this case, this strategy is doing a good job of softening things out, basically dampening the spike, and then building a bit of treasury to then support the market later when people are trying to sell.
Well, the most charitable way to look at trading in markets and making a profit of buying and selling, because a lot of people just say it's like zero sum or whatever. But if there is actually something being built and people do actually want in on that, somebody has to be selling, right? So if nobody sells during that like initial period and people really want to get in on this project that's actually supposed to be some good project, let's just forget about like straight memes for a second, because that's more of like a Ponzi vibe. But if people are actually trying to get in because it's a project that they want to be in for like a longer period of time, and nobody sells, then nobody can actually get in. So that kind of actually is not great, because for the long-term health of a project like that, you want lots of people holding the token, right? You don't want a small group of people holding the token, and then if any one person sells, it could be catastrophic for the project, because it's like, oh God, like 20% of our token is about to hit the market in one go because one person,
that's true,
I don't know, like they got old and something happened, they like broke their hip and then they needed to like sell all their, like that happens with companies all the time, right? Like people eventually want to retire or something. So even if it's like everything's going perfectly, there could still be like huge liquidity events in a company that has no distribution.
Even distributions.
Just for like life reasons, right?
Yeah. Okay, cool. So anyway, so in that case, having a dampening the pump is equivalent to getting a more even distribution of tokens during the launch, is what you're saying.
I don't know if it's equivalent to, but I would say that there's probably a good correlation there, which is like if there's a mix of people buying and selling over a long period of time, and it's a good mix of buying and selling over a long time, then eventually that token is going to be.
Yeah, I think that's good. I think that makes a lot of sense. I think everyone in the project, I think all the holders want that too. Like the holders of the token want to know that there's lots of other people holding for the same reasons. I mean, they don't want.
The other thing is timeframes. Like my time frame for holding a token could be 6 months, and yours could be 5 years. And I know a lot of these tokens that pop up, it's like crazy to think about it being 5 years, but like this Bitcoin that I'm rotating out, I've had that for like more than 5 years. So it's totally a thing.
Yeah.
Why not? So even if so when one person's selling, they may have made like a big profit, but that could be a great entry for somebody else who's actually like got a different time frame, right? So all of this stuff is happening all at the same time across many different market participants, and the whole point of the market maker is to be making this work without direct matchmaking, right? Like if you wanted to sell and I had to like actually go and matchmake you with someone who wanted to buy, but that person was going to actually make the purchase 3 days later, the trade never happens, right? Because there was a time gap between when the buyer and the seller actually wanted to do their business. So you can't matchmake across time. You can't time travel. So having the market makers sit in between, they're sort of like holding it, and then they're facilitating that trade through like a multi-hop thing over time.
Yeah, that's the DEX. I mean, that's the DEX. That's the massive innovation of DEXs, AMMs. The problem with them is that they're limited in their market making algorithm. There's only, I mean, people are now creating like, we've got V3 with concentrated liquidity, and we've got like different advances, but our answer to it is just like give people full control over the algorithm. Just let them write whatever algorithm they want, and let's see what people create. Anyway, so
it's not one size fits all. One size fits all.
But anyway, but this strat does appear to do well over a couple of different situations. So we've done the launch situation, we've done you as the trader situation, and then the other workplace we've deployed this strategy was for a token that had been running for a while. They're like well past the launch phase. They're kind of into like the mature, yeah. And they literally just wanted to add liquidity to the market. So, but again, their pool's pretty good. But it's still really helpful for them to run this strategy alongside that as well, to add even more liquidity and to do so in a way that's kind of, I mean, one way of thinking about it is like they're hedging against IL on the pool, or at the very least, they're not increasing their losses. They're able to have some way of controlling the way that they're like drip feeding liquidity into the market. And this one's going really well. Like they're like basically crabbing. They've been crabbing for like a week, and their like annualized APY is like 50% right now. Based on
they made 1% in a week.
They made 1% in a week, which is 50% over a year. Yeah.
Also, because they didn't run into the situation that I ran into with a huge dip followed by a huge pump, and they've just been ticking over. They had the opposite situation to me. So I didn't have enough ETH to cover the drawdown. I would actually say that they have more in their vaults than they needed relative to their drawdowns. So about double, actually. So if they had hypothetically perfectly predicted their drawdown, or they had like micromanaged their drawdown or whatever, their APY would have been more like 100%, because they only used like half the collateral they actually put in. But I'm pretty sure the reason they just put the extra in is because they didn't want to think about it. So for them, it's not like the money's gone, it's just sitting in the vault. They can take it out at any moment. It's just
unused right now. I mean, it would be interesting.
This is when you calculate APYs, it's like, how do you actually calculate the APY when someone's just put in a bunch of buffer just so that they don't have to like worry about topping it up in case there's some kind of drawdown? You know what I mean?
Yeah. Well, I would say, yeah. I mean, the thing is, the capital isn't really like at risk in the way that you like, because you don't have an opinion about, because when you put it in, you don't have an opinion about which token you want profit to be denominated in. As long as you're
Yeah.
happy to have either token, then your capital is not actually at risk. The worst case scenario, as we said before, is you end up all in one token. But as long as you're happy to hold either of those tokens, that's why I think the ETH BTC thing is really interesting. Like, I'd love to see this run on ETH BTC. I would do the same thing for ETH USDC, to be honest. Like, because my long-term horizon for either like I'll make a short-term profit in USDC, which is cool, or I end up with a bunch of ETH, which is fine too, because my long-term horizon for ETH is like I've got a long horizon, like you're talking about before, for ETH. So I don't really care if I end up just with a bunch of ETH. But BTC and ETH is even more interesting.
Yeah.
And for these guys, it's either USDC or it's their own token, so they don't really care. They're just trying to provide liquidity. So the risk for them is like there is no risk that they end up in one or the other. I don't know how. I mean, maybe in future iterations we'll figure out how to better optimize or do better modeling or.
Yeah, we'll figure that stuff out. I mean, we added volume. That seems like a pretty basic thing to add, but we did add some kind of metrics to the app.
Yeah, should we look at that quickly? Oh, we looked at it before.
I had it up before. Yeah.
That's fine.
So the thing I'd say about this is that having this third example, where it's like more mature and it's just running, is you can see in the market, if you're on Dex Tools or whatever, they've got their pool and people are putting in lots of small trades against that. Like I think there's even like a bot just going crazy on that.
Yes,
like lots of trades in there, but the pool isn't going to actually push against a trend in any way. It's just going to slow a trend, if that makes any sense. Whereas this is actually going to, when it's up, it's actually going to be selling, and when it's down, it's actually going to be buying, right? So I guess the pool kind of does that in like a fairly passive way, but this is actually like checking the market with the auction, like periodically being like, okay, is this above where it was? And it's actually kind of, it's sort of like always pushing back against wherever the market is trending against. So in a way, it's actually making the market even crabbier. Like it's pushing, it's just doing little nudges.
That's what I'm saying. It dampens volatility.
Yeah, but not in a way that a whale can take advantage. I mean, some people want whales to be able to make big trades. Like if your project is a stable coin, you want somebody to be able to come and put a $1 million trade in or a $10 million trade in, that not move the market at all. But if you're a smaller project, maybe you're totally fine with like in total over the course of a few days or a few weeks, $1 million running through the token through like lots of smaller trades, because maybe that implies lots of different people buying and selling rather than one person just like sitting there like trading, like chunking it out. So having the smaller pool, I guess, encourages more people, like more of the retail participants to, because they don't suffer any of the slippage. Basically, they get fine slippage, and then the strategy only kicks in to push things back towards where it was when you actually hit some kind of threshold. And it's not an exact threshold; it's based on an auction, but you can see it. You can see it like the spread comes in and then it intersects with the market and then it like nudges it back into wherever it was previously. So that's it's more of an active smoothing rather than just friction. Like an AMM pool is just friction. That's all it is.
I mean, it comes down to what is the ultimate goal. If you are a token issuer, what is your goal? Like, what is your end game? Because it can't just be the price goes up and up and up. Like we said before, if the price goes up and up and up, it will just dump again. Like no, there's no such thing as an up only thing. So what is? I mean, maybe over the long term, but even in the midterm, what's the goal?
Yeah, you know what we have been doing recently, which I think has been working a lot better, is sort of when we started this, what you just said, we would try to write a strategy that encompasses like what is your goal, is like everything your goal could possibly be. And now it's more like the Unix philosophy, which if you don't know what that means, it just means like having like a toolkit, and each tool just like does one thing. So rather than so making like a bunch of smaller strategies, and you can easily run a Uniswap pool, a dynamic spread, a dollar cost averaging strategy, a one-stop auction. You could run all of those strategies at the same time at different times because you have different goals on different days of the week, right? Like during your launch, you have a different goal to the week after the launch, and a different goal to a month after the launch, and a different goal to a year after the launch. And maybe you're doing like a marketing campaign somewhere along the way and you want a different goal for that. So actually being able to have a toolkit of smaller strategies that aren't trying to do everything, and just focusing more on like, okay, well, when do I deploy that and how do I parameterize it to fit what's actually going on in the real world, is way smarter and more effective than trying to like make one big strategy that has all of that baked into it.
I agree with that. I mean, when I said what is the goal, I wasn't suggesting that we should come up with the strategy for that. I was more thinking like, yeah, it was more in you saying like about how this strategy can like basically cause whatever's happening to be more crabby. And I was thinking about what that, I mean, it could just be that if something's crabbing, it's just changing hands between like people. So you've always got 50 holders holding about the same amount, and one of the 50 leaves and another one comes in. But that's not what you actually want. You want to have more people come in. I think you're right. You want a more even distribution. So you kind of want the number of holders, or you want the distribution of the token to increase faster than the price, because if the price and the holders increase together, then that means the price is going up because nobody's selling, but eventually people will start selling, and then it could just, like you said before, you've got less people to hold things if a couple of people start selling. But if you've got the distribution of holders increasing at a faster rate than the price, that's good, because the price is still going up, which is good, but you're getting basically more people or more distribution, which means you've got more to hold that price in place.
Yeah, like going back to the Ethereum example again, the Ethereum Foundation, a lot of ETH, like every time they sold early on in ETH history was bad for the markets. Well, it wasn't bad for the markets because it actually meant that other people could buy it, but it definitely made the price go down. It was like a news headline, and they were very good at selling the top. And I don't know if that's just because they caused the subsequent not it being the top anymore, or if they were just very good traders. But Ethereum Foundation dumped like $100 million worth of ETH like a week ago or 2 weeks ago. And like some people wrote about it, but ultimately it was a nothing burger, really, because that market is now mature enough and there's enough people with enough size in there that even when $100 million from the Ethereum Foundation, which is like the definition of that big whale that like has all of your token, it just didn't do anything, really.
Yeah. It's crazy. Yes,
that's what you want.
That's every token's goal. Well, on a later stream, we're going to talk about community liquidity and things. But I think today, that's good. That's an hour. I think that was a good stream.
Good chats, yeah.
Cool. So the show's now called Strat Chat. So now we need to make an intro video now.
Yeah. Are you going to retroactively go through all the videos and rename them to Strat Chats?
Oh, maybe we should make a song.
Maybe you can make a song. That definitely sounds like a you thing.
Maybe we should make an AI song. We'll get AI. We can make an AI song called Strat Chat. All right, I'm gonna do this for next week.
You're probably not.
Oh yeah. The next time I come back.
Yeah. Josh is going to be away for a bit.
Yeah, and then when I come back, I'll make a Strat Chat song.
Yeah.
All right. Thanks, everyone. Cheers for watching. Join us on Telegram if you haven't already, and see you soon.
Yeah.